Test.
Test. Good morning, ladies and gentlemen. We, from University of Malaya, are here to share with you our investment view on Sunway. I'm Kaylin. I will start with the business overview and recommendation, followed by my colleague, Ifti, who will discuss on financial analysis, followed by Wenhao on evaluation and investment risk. Sunway is a diversified portfolio which with a growing assets of retail, hotel, and office. Its key retail segment is the key contributor that contribute to 70% of its total net property income. It is also geographically diversified across 4 states. The stock price shows that there is a reason steady increasing in the share price and also steady distribution yield. In general, a general outlook shows that there is a surge in the retail and office space. However, there is actually opportunity for those assets that are well positioned and well managed. For the hotel segment, Malaysia's position as an emerging international MICE hub acts as a solid growth driver for the corporate guests. Meanwhile, Visit Malaysia year 2014, which aims to attract 28 million tourists, will be the catalyst for the retail and hotel sectors. In short, there is a premium opportunity for those assets which are well positioned and well managed, and this is where Sunway comes in. Ladies and gentlemen, today we would like to initiate a buy call with a target price of 1.57 ringgit with a potential upside of 37% from the current price of 1.24 ringgit. Our buy call is based on 3 unique aspects of Sunway. First, Sunway is the one and only integrated township in Malaysia. Second, it enjoys 2-digit rental reversion on its retail assets. And lastly, it will replicate its success to the 3-in-1 new development Sunway Putra Place. Ladies and gentlemen, would it be good to have a dream house? Greater still, to be in a dream neighborhood. Imagine a place where you can learn, live, work, play and shop. This is where we start our first buy call, which is one integrated township concept. It is an all-in-one asset where you can find nowhere but Sunway Resort City, Malaysia's first and only fully integrated township in Malaysia. 4 of these assets are managed by Sunway. Assets in this growing township is well connected internally and externally through its improved connectivity, and this will create a larger synergy that brings more footfall into the area. This translates into long-term sustainability, which also proved by the assets which will be injected into the REIT. This will further enhance the growth potential of Sunway REIT. Second is the rental reversion. 2-digit rental reversion enjoyed by the retail segment of Sunway REIT. This asset has enjoyed 2-digit rental reversion from the past few years, and it will continue to enjoy this premium. Therefore, we continue to see increase in the rental income. Last but not least, our third buy call is a 3-in-1 new development Sunway Putra Place, comprises hotel, office, and retail. It aims to develop as a lifestyle urban chic mall that attracts middle and upper middle income shoppers through its excellent connectivity. The management expectation of ROI yield of 8% is indeed a new growth impetus. We believe that this project is viable because the management has the expertise to replicate its success of integrated township into SPP the new jewel. With the 3 unique buy points I mentioned, we now proceed to the financial analysis.
Nothing tells a story better than numbers for an investment. I am Iftikhar and I will continue with the financial analysis. We do not expect a repeat of the exponential growth in the first 3 years of its operation that started on a low base. We project a 6% growth in earnings, which will be in turn derived at 4% growth in dividend per unit. In 2014 and 2015, we expect a fall in earnings because of cost hike. However, in 2016, the earnings will grow exponentially because of SPP. Next, in the waterfall chart, we see how earnings increased from FY13 to FY16. There are 3 main contributors, with organic growth and SPP the positive and cost hike the negatives. The organic growth will be boosted by strong rental reversion from its retail segment and office segment, and its occupancy for its hotel segments. We are confident with the management expectation that the Sunway Pyramid Shopping Mall will continue to enjoy two-digit rental reversion, and the medical center will provide a steady earnings growth. With this, the occupancy level of the hotels will also be constant with strong promotional activities. The next is SPP. SPP is a 3-in-1 combined development which will boost the earnings by a further 28 million. In SPP, the SPM, we project 80% conservative occupancy rate with 480,000 square feet, which equals to around 8 football fields. This will create synergy for the 2 other office and hotel segments over there. Next, we move on to the cost hikes. The cost hike of 28 million will come from increase in financing costs, electricity tariff, and also KL assessment rates. Due to the diversified portfolio, the KL assessment rate hike will be diluted, and its energy saving initiative will dilute the effects of the increase in electricity tariff. In sum, despite the danger of cost hike, we are confident that the organic growth and the SPP will push forward in the future growth. With 6% earnings, it will, and a 95% payout ratio, we get a 4% dividend per unit growth. We transfer this 4% into our daily valuation.
Warren Buffett once said, "Price is what you pay, value is what you get." That said, allow me to present to you Sunway REIT's valuation. We consider 2 popular REITs valuation methods, namely discounted dividend model and PE multiple. DDM incorporates the company's long-term growth potential, while PE multiple is a good proxy for market expectation. First, DDM is a suitable method because of the company's near full distribution payout policy. We assume a stable distribution growth rate of 4%. We also estimate its cost of equity at 8.6% based on the CAPM model. Our DDM-based valuation suggests a target price of 1.75 ringgit. The next slide shows the computation of our DDM valuation. Moving on to the PE multiple approach. We consider both justified PE and peers PE to calculate our target price. Justified PE is based on the future growth of earnings per unit, while peers PE is the weighted average ratio of comparable peers in the Malaysia REIT market. We then combine the 2 multiples, resulting in a target price of 1.38 ringgit. Finally, we took an average of both valuation methods to obtain a fair price of 1.57 ringgit. Ladies and gentlemen, allow me to show you what can potentially go wrong with our recommendation. We classify our risks on the basis of their impacts and likelihood, and we focus on the risk in the upper half section. First, the Sunway Putra Mall project may be delayed due to slower renovation work or insufficient tenants. Our sensitivity analysis shows that every 1 month delay will reduce earnings by 1.5 million ringgit. Second, lower occupancy rate than expected in the retail segment, where every 1 percentage point drop in the occupancy rate will result in an earnings drop of 2.7 million ringgit. And third, financing cost increase due to higher loan rates, where every 1 percentage point increase in the financing cost will reduce earnings by 3.4 million ringgit. However, our investment risks are minimal. This is due to the company's good management, and good location. To change our buy call, the earnings must go down by 22%. It will take either the rental rate to go down by 17% or the occupancy rate to go down by 16 percentage points. Chances of either that event happening are remote because of the company's good track record of occupancy rate and rental reversion. To wrap up, let's recap our 3 buy points, namely 1 integrated township, 2-digit rental reversion, and 3-in-1 new development. This uniqueness will give Sunway a competitive advantage, translating into a sustainable growth. And our conservative forecast further provides a solid ground for our buy recommendation. Thank you.
Do you have the in terms of deriving your DPM, did you have to use a terminal value? Because you can only forecast up to a certain period and beyond that. So what sort of terminal value did you use?
Yes, we only forecast for 3 years, from financial year 14 to financial year 16. For our stable growth rate, we have a stable growth distribution rate which set at 4%, and by using the COE as our discounted rate, we will come out with a 1.55 PV value for our stable growth period. By combining the 3 years projected PV value and the stable growth rate value, finally we come out with a 1.75 target price for our DDM method.
The 4% growth rate seems a bit high. What's the assumption behind that?
To get the 4% stable growth rate, first, we estimate our CAGR of DPU growth rate is 4%. Second one, actually we have not taken into consider the new acquisition in our financial analysis, but by following the Sunway Risk management team, actually they have a future plan to inject the new asset which can bring them the 7% yield return for their company. So by using, if the new asset is injected into our Sun company, so the return can bring at least 7% yield return to our company. So 4% seems is lower than the 7% new acquisition asset.
It's a bit weird why you use 50% PE, 50% DDM. Why not just, because this is free cash flow. I mean, it's distributable income, and you can basically forecast why use PE and why your PE is at a premium. So I don't really get your understanding where your valuations are coming from. I mean, this is a REIT, it's not a property company or something else.
To answer the question on why we choose a 50-50 average on both methods, it is because we want to know the intrinsic value of the company by using the DDM method. Of course, we also want to know the market sentiment so that we can have a more average fair price for our valuation.
Then your risk-free rate, your cost of equity is 8.6%. Your risk-free rate, what are the chances of it going back up to 5.5%? And what is your historical average for the last 10, 20 years?
By using the KM model, the risk-free rate, we are using the 10 years in GSU, which is trending currently in 4.2%.
I know, what's the trend of that 10 year?
The 10 years MGS use is in the increasing trend.
So, wouldn't it be more conservative if you use a higher risk-free rate? And have you calculated your sensitivity to your risk-free rate?
Yes, actually we have calculated the sensitivity to our risk-free rate. But according to our market research, the 4.2% MGS yield is reasonable, and although the interest rate of MGS is increased until 4.5%, which is the maximum for us, is the maximum, because the BNM, Bank and Government Ratio, is not allowed, will not allow the MGS yield to increase until a certain limited limit. So 4.5, if we use, by using the 4.5% as our risk-free rate, our target price will still within the 1.24 to 1.57. It's still a buy call.
Very interesting statement on the bank garang. I want to ask, what's your debt maturity profile? I mean, you give me a sensitivity on your interest rates, but what's your debt maturity profile for this company over the next 5 years?
Could you repeat the question, please?
This company has debt. What is the debt maturity profile?
Their long-term debt is maturing in 3 years' time.
Is it a bullet payment?
It's a one-off payment.
Okay.
So after that, they're
So
gearing,
what are they paying on that now?
uh,
On the long-term debt?
on the long-term debt, they're paying around 3%.
Okay. So going forward in 3 years' time, do you think you can refinance at 3%?
With their current initiatives, I am sure they can manage the 3%.
You sure?
Sure.
Allow me to add on to the previous question and answer. Sunway Rates has a current high fixed rate loan of 80% due to their recent debt restructuring exercise, and that will certainly mitigate the risk of any interest rate hike.
My last question, your rental reversions seems a bit high. No? I know you can look at historical, but your 16% for Sunway Pyramid is a bit high, don't you think so? Relative to your Pavilion and your Mid-Valley, those guys are going for 3% per annum, so it's about 10%? So your 16% looks a bit steep.
In the Sunway Pyramid, we have to also consider its location, strategic location, and the footfall it brings along with it. Because of the integration.
What is the footfall of Sunway against your other two major listed REITs?
For Sunway Pyramid, there's an annually 30 million arrival in the shopping mall.
How about KLCC? How about Pavilion and Mid-Valley? Gardens Mid-Valley?
As we know, the integrated township in Sunway, it is the uniqueness. However, we do not have a value for the KLCC and Pavilion arrival. But we believe that with the 30 million footfall, it does bring a good traffic flow in the mall that maintains tenancy in the area.
I presume you spoke to the management of the company before you came up with your report. So how does your numbers compare with management? Are you following their guidance or have you put your own kind of assumptions?
We have gotten the assumptions from the management, their current rate of increase, and we have discounted it by 10%. Suppose they have had occupancy at 90%, so we have assumed they will have an 80% occupancy rate.
Adding on to that, we are also very conservative in the distribution payout policy. The historical distribution payout policy has been 100%, but we have been more conservative by putting it 95%. That makes our valuation more resilient.